Welcome to the deep dive. Today, we are undertaking a bit of an intellectual archaeology, really digging through the entire stack of sources, the founding texts, the articles, the biographical details that define one monumental figure in finance, Benjamin Graham.
Yeah, he's just one of those figures you can't ignore.
Not at all. This is the man who didn't just teach investing. He basically built the entire intellectual infrastructure of how we analyze companies.
It's truly impossible to overstate his importance. He wasn't just some successful investor. He was an economist, an accountant, a relentless professor at institutions like, Columbia and UCLA.
A true intellectual.
A true intellectual who fundamentally changed how we think about risk and value. We are, without a doubt, talking about the undisputed father of value investing.
Okay, let's unpack this. The sources really confirm that his enduring legacy is cemented in his writing. So we are focusing heavily on the two cornerstones of the discipline.
The big ones.
The big ones, security analysis, which he co-authored in 1934 with David Dodd, and then the massively influential The Intelligent Investor from 1949.
And that second book, of course, is the one that Warren Buffett famously called the best book about investing ever written.
Which is quite an endorsement.
That's a heavy endorsement.
Yeah.
And it holds weight because Graham didn't just define a strategy. He, in a very real way, defined the profession.
How so?
Well, this deep dive is crucial because Graham essentially laid the philosophical and the technical groundwork for the entire security analysis profession. In fact, his insistence on analytical rigor and codified ethical standards was the primary driving force behind the establishment of the Chartered Financial Analyst designation.
The CFA.
So every time you see those three letters after an analyst's name,
That's right. Their foundational training, the very DNA of their work, traces back directly to the principles Graham established in security analysis.
that sets the stage beautifully. Our mission today is to go far beyond just the surface definition of value investing. We need to explore the core analytical concepts, like the margin of safety with the technical rigor they deserve.
But just as importantly, we need to connect those concepts back to the incredible life of the man himself, exploring the lesser-known facts about how his early trauma really shaped his entire financial philosophy.
To understand why Graham's philosophy is so obsessed with the preservation of capital, we have to start with his earliest, most formative financial experience, and it was one of utter catastrophe.
Graham was born Benjamin Grossbaum in London in 1894. He was an immigrant, moving with his family to New York City when he was just 1 year old. But that name he started with, Grossbaum, that's a key piece of this puzzle.
It is. The name change is often a subtle detail in his biography, but the sources make it clear it was a defining choice, and one driven by necessity.
It wasn't just for flair.
No, not at all.
Uh-huh.
The family changed their name from Grossbaum to Graham specifically to assimilate into American society, and crucially, to avoid the rising anti-Judaic sentiments and discrimination that were prevalent at the turn of the century in certain business circles.
So this wasn't just an administrative choice.
It was an act of survival in a really challenging social backdrop.
And then came the financial disaster that truly forged his approach to money. His father, who had successfully established a porcelain shop, passed away when Benjamin was young. But the ultimate blow, well, it came swiftly after.
That was the panic of 1907. The family, already struggling after the loss of the primary breadwinner, suddenly saw their remaining assets and their entire standard of living just vanish.
Gone.
They fell into crushing poverty. And the sources are so explicit about this. This traumatic experience, witnessing capital evaporate, and the profound real-world consequences of financial insecurity, was the catalyst for Graham's lifelong quest for investment values.
How does that trauma, that psychological scarring, translate directly into a financial methodology? I mean, it's one thing to say, I want to be rich, but it's quite another to build an entire system based on not reliving 1907.
It defines his entire worldview.
Yeah.
The experience taught him that risk isn't just a statistic on a page. It's a visceral danger that can dismantle a family.
It's
It's very real. Therefore, the primary objective of any financial decision has to shift from maximizing spectacular gains to establishing an impenetrable defense against a catastrophic loss. That early trauma is literally the emotional and intellectual underpinning of the margin of safety concept.
So it's the mechanism.
It's the mechanism Graham designed to ensure that if the market tries to replicate the panic of 1907, his capital is already fortified against it. It's an intellectual fortress.
And what's truly remarkable is the sheer intellectual horsepower that emerged from this hardship. I mean, despite the poverty, he was a phenomenal student. He entered Columbia University at an incredibly young age of 16,
16.
and he graduated as the salutatorian in a blistering 3.5 years. That speed and that comprehensive grasp of knowledge, it just points to an extraordinary mind.
It speaks to a deep internal drive. And the famous anecdote about his graduation just confirms his unique genius. The sources note that before he even finished his senior year, Columbia offered him teaching positions in 3 different departments simultaneously:
3 different departments. That's incredible.
mathematics, English, and philosophy. To be considered an expert in all 3 disciplines, the rigor of math, the critical analysis of philosophy, and the communication skills of English, it just shows he was a genuine polymath.
Most people would leap at the chance to pursue an academic career, especially one that offered such diverse intellectual freedom. But he chose Wall Street instead. Why the hard pivot away from academia?
Well, again, we return to that shaping experience of poverty. He chose Wall Street because he needed to immediately support his widowed mother.
It was practical.
It was purely practical. Intellectual freedom was a secondary concern to financial security. He started his career there, later running various private partnerships, and eventually founded the very successful Graham-Newman Corps starting in 1936.
So he learned by doing.
Exactly. This trajectory means the man who formalized financial education taught future analysts, but only after gaining his mastery in the tumultuous, often unforgiving trenches of the market. He earned his theories through practical application, not purely abstract thought.
That Columbia offer math, English, philosophy, it gives us a glimpse into the comprehensive mental toolkit Graham brought to investing. We shouldn't pigeonhole him as just the dean of Wall Street who crunched numbers.
No, he was a true Renaissance man.
A true Renaissance man, and we really need to explore how his non-finance intellectual output shaped his investment mind.
It's the synthesis of these disparate fields that made him so effective. Beyond finance, the sources detail his practical mechanical genius. For example, he patented 2 innovative handheld calculators.
Really?
Yeah, this shows an interest not just in using numbers, but in the efficiency and the mechanism of calculation itself. It's a mindset that demanded absolute clarity in analytical inputs.
And then there's the sheer left brain, right brain split, which is exemplified by his foray into the arts. He actually wrote a Broadway play called Baby Pompadour.
Of his thing, isn't it?
The man who codified the calculation of intrinsic value was also writing dramatic comedies for the stage.
That breadth is extraordinary, and it feeds directly into the clarity of his writing. He could simplify these incredibly complex financial topics into accessible language and memorable metaphors, like Mr. Market, because he had mastered communication.
That's the English and humanities influence coming through.
Absolutely. He knew how to tell a story and frame an idea effectively. It's one thing to have a good idea. It's another thing to be able to teach it to millions of people.
His language skills went beyond English, too. By the end of his life, Graham knew at least 7 languages.
7.
And he taught himself Spanish, not for a business trip, but specifically so he could translate Mario Benedetti's major Uruguayan novel, The Truce, into English. That level of dedication to intellectual pursuits outside his highly profitable day job is just stunning.
It shows his core identity was that of an intellectual, and finance was merely the practical application of his intellectual rigor. Think back to those 3 disciplines Columbia offered him.
Right, mathematics, English, and philosophy. Let's break down that connection fully. How do those 3 subjects merge to create value investing?
Okay, so mathematics provides the essential analytical rigor for security analysis. It's the ability to compute intrinsic value. The power of Graham's work really begins with the absolute precision of his definitions. He sought to impose a kind of scientific rigor onto the often chaotic world of finance.
And we must reiterate the 2 cornerstones. Security Analysis from 1934, which is really the technical manual for analysts, and The Intelligent Investor from 1949, which is more of a philosophical guide for the general public.
That's a good way to put it.
And what these texts did was draw a hard, unambiguous line that forever changed how the financial world operated. The distinction between investing and speculation.
And this distinction wasn't abstract. It wasn't just semantics. It dictated whether an operation was professionally respectable or inherently risky. The definition he gives is a legalistic, rigorous framework.
So what is Graham's definition of an investment operation?
It is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are
But
speculative.
notice the necessary components there.
It's a three-pronged test. It requires thorough analysis, no shortcuts, no gut feelings. It must promise safety of principal protecting the money first is paramount. And it must promise a satisfactory return, a reasonable, not a spectacular expected yield.
If you fail even one of those three tests, you are automatically categorized as speculating. That is incredibly strict, especially by modern standards where high-growth, high-risk strategies are often lauded as investments.
It entirely shifts the burden of proof. It forces the buyer to prove, analytically, that the principal is safe. And this leads directly to Graham's insistence on adopting the business perspective.
Right.
He taught that the owner of stocks should regard them, first and foremost, as conferring part ownership in a business. You're buying a small slice of a concrete enterprise with assets, liabilities, and employees, not merely a ticker symbol on a screen.
If you internalize that, it immediately changes how you react to market fluctuations. I mean, if you own the entire business, you wouldn't panic and sell the whole thing just because the quoted price for porcelain shops was down for a week.
Exactly. You would focus on the actual operations. Are sales up? Are the costs managed? Are the profits increasing? Graham demanded that level of scrutiny for even a single share of stock.
So the business perspective is the philosophical engine, but the concept it drives, the central defining concept of Graham's philosophy, is the margin of safety.
Yes.
It is the core mechanism he developed to ensure the safety of principal. So what is the technical definition of the margin of safety?
The margin of safety, in its simplest form, is the existence of a favorable gap between the intrinsic value of a business and the price at which you are able to purchase its stock.
So a discount.
A significant discount. Graham insisted that a security is only suitable for investment when it is available for purchase at a significant discount to its rigorously calculated intrinsic value.
Now, we need to go deeper here. To an informed listener, intrinsic value is a necessary, but, it's an abstract term. How did Graham in the 1930s and 40s actually calculate that value? What were the specific analytical techniques he taught in security analysis?
This is where the technical rigor comes in. For Graham, intrinsic value was highly dependent on tangible, verifiable assets. He preferred asset-based valuation methods, and the most extreme example of this was his focus on net working capital stocks.
Okay, explain net working capital for us.
It's extremely conservative. I mean, bordering on paranoid, but in a good way. You calculate the net current assets by taking a company's current assets, so cash, receivables, inventory, and you subtract all of its liabilities, both current and long-term.
All of them.
Everything. If the stock market price for the entire company was less than this highly conservative liquidated value of its current assets alone, Graham called it a net-net.
So what does that mean in practical terms?
It essentially means you're buying the current cash and inventory for less than cost, and you get all the property, plant, and equipment, the long-term assets, the factories, the buildings, for free.
That sounds like a radical form of buying insurance. Why is such a focus on the most tangible liquid assets?
It goes directly back to the 1907 trauma. Cash and current assets are the most reliable figures in a financial report. They are the least susceptible to management obfuscation or overly optimistic forecasts. By insisting on purchasing stocks at a discount to net working capital, he maximized the margin of safety, creating an extraordinary buffer.
So why does this margin of safety matter more than just getting a good deal?
It is the systematic minimization of risk. The margin acts as an ironclad buffer against two crucial risks. First, unforeseen business difficulties, a sudden recession, unexpected competition, a regulatory shift, things you can't predict.
The unknown unknowns.
Exactly. And second, and equally vital, it guards against errors in your own analysis.
Because even the most meticulous analyst can be wrong. The buffer is the admission that human analysis is fallible.
Precisely. Graham recognized that the future is inherently unpredictable. So by insisting on a significant discount, you absorb potential forecast errors and you systematically minimize the probability of suffering a severe, permanent loss of capital. For Graham, the margin of safety wasn't a path to high returns. It was the mechanism that ensured the safety of principal, fulfilling the first non-negotiable requirement of his investment definition.
Now, Graham, the great communicator, recognized that asking millions of individual investors to perform exhaustive net analysis was just. It was impractical. So he defined two distinct paths based on required effort and skill. This is how he helps you, the listener, categorize your own approach.
These two archetypes are determined by the time commitment an individual is willing to dedicate to rigorous analysis, and that choice dictates the complexity of the strategies they can actually employ.
Let's start with the path most people should probably choose, the defensive investor.
The defensive investor seeks to minimize three things: time, effort, and worry. This person accepts that they cannot dedicate the required hours to perform exhaustive intrinsic value calculations.
So their strategy has to be simple.
It has to be simple, mechanical, and resistant to emotional decision-making. They seldom trade, they renounce any attempt to forecast market behavior, and they focus entirely on holding a diversified, financially strong portfolio for the very long term.
This sounds like the precursor to the modern retirement portfolio, a low-effort, high-discipline strategy.
It is the ultimate practical wisdom for the non-professional. Graham provided specific, simple criteria for a defensive investor to use when selecting stocks. Things like stable earnings, long-term dividends, a firm capitalization ratio rules designed to achieve an adequate return without requiring exhaustive research or succumbing to market noise.
Okay, then we have the other path, the enterprising investor, also known as the active investor. This is the path of the professional or maybe the highly engaged amateur.
Right. This person has both the financial interest and, crucially, the time to devote to original, painstaking analysis. They're the ones seeking truly exceptional buys, those deeply mispriced securities that allow for a maximized margin of safety.
What is the non-negotiable prerequisite for the enterprising investor?
Graham was unequivocal on this. If you choose this path, you must devote substantial time and effort to analyze the financial state of companies. You have to seek out those deep value opportunities, sometimes in obscure corners of the market that the defensive investor ignores.
And if you can't?
If you are prepared for the analytical rigor that might take dozens of hours per company, calculating liquidation value, assessing future earnings power, scrutinizing balance sheets, you must immediately default to the defensive investor approach. The market offers no prize for a half-hearted active investor. It only offers losses.
Here's where it gets really interesting. Graham was not just a great accountant, he was a brilliant philosopher of emotion. He knew that even the most rigorous analysis fails if the investor can't control their own panic or their own euphoria. So he gave us these powerful mental frameworks to combat internal irrationality.
The Mr. Market metaphor is Graham's ultimate masterpiece for emotional detachment. It personifies the manic, erratic nature of daily stock prices as an eccentric business partner.
Detail this character for us. He's central to understanding how to deal with market sentiment.
Okay, so imagine, Graham proposed, that you own a private business with a partner named Mr. Market. And Mr. Market turns up every single day at your door, without fail, and offers to either buy your share of the business or sell you his share, always at a new price.
Every single day.
Every day. The price is usually plausible, but sometimes when he's deeply depressed or wildly euphoric, the price he quotes is just ridiculous.
And what is the investor's power in this daily interaction?
Your power is absolute freedom. You are entirely free to ignore him completely. Mr. Market doesn't mind this at all, and he will return the next morning, bright and early, with a brand new price reflecting his latest emotional swing.
So the lesson is clear.
The core lesson is clear. Investors should never allow the whims of Mr. Market, his temporary state of panic or joy, to determine the value of the shares they own.
So the goal isn't to react to him, it's to exploit him.
Precisely. The intelligent investor's role is to stand ready to profit from market folly rather than participate in it. When Mr. Market is euphoric and overpaying, you sell to him. When he is depressed and offering a massive discount, providing a large margin of safety, you buy from him.
And your focus has to remain on the business itself.
Your focus must remain rigidly on the long-term fundamentals and performance of the underlying business, not the daily price quote he's shouting at you.
I often find that modern commentary struggles with this. I mean, when the market is flat or rational, everyone agrees on Mr. Market. But when prices crash, even seasoned investors find themselves listening to Mr. Market's panic. Why is that emotional detachment so difficult?
It's difficult because price is concrete and value is abstract. Graham's philosophy is an intellectual exercise, and it demands independence. When prices drop 20%, the fear centers of the brain activate immediately. You feel pain.
A real physical sensation.
Right. And Graham's framework forces you to replace that pain with a question. Has the intrinsic value of the business I own actually declined by 20%? If the answer is no, then Mr. Market is simply offering you a better deal than yesterday. Philosophy gives you the toolkit to fight your own biology.
This brings us to the second, equally crucial metaphor, which explains the long-term mechanism of how value overcomes price.
Yes, the voting machine versus the weighing machine.
Graham observed that in the short term, the stock market behaves exactly like a voting machine.
The voting machine is driven entirely by emotion, by popularity, by narratives, and who is currently winning the headline battle. It counts sentiment, which leads to volatile and erratic fluctuations. This explains why a company with poor fundamentals can briefly soar if it has an exciting story.
Or why a solid company can be temporarily penalized if the headlines are negative.
Exactly, it's just a popularity contest.
But the long-term truth is defined by the weighing machine.
The weighing machine is the ultimate arbiter. Over the long term, the market acts like a scale, and it inevitably measures the company's true intrinsic value. This value is based on its underlying financial condition, its tangible assets, and its sustainable earning power.
So eventually, the weight of those fundamentals.
The weight of those fundamentals, the truth of the business, will be reflected in the stock price, and it will wash out the temporary votes.
This framework is a tremendous source of intellectual and emotional comfort for the listener. It explains why they should remain committed to their analysis, even when the short-term noise is deafening.
It provides the intellectual basis for being unconcerned with erratic fluctuations in the short term. The challenge in modern markets, I think, is determining how long the short term actually is. In Graham's day, market cycles were often shorter. Today, with massive liquidity and global information flows, the voting machine phase can last for years. This only reinforces Graham's point. The longer the voting machine persists, the greater the eventual reckoning when the weighing machine finally delivers its verdict.
And connecting all these ideas, the margin of safety, Mr. Market, the weighing machine, is Graham's plea for independent, self-reliant thought. He insisted that if you've done the analysis, you must trust it, regardless of external validation.
This is the highest expression of the philosophical rigor he developed at Columbia. The famous quote here is essential. "You are neither right nor wrong because the crowd disagrees with you," Graham wrote. "You are right because your data and reasoning are right."
That quote is the ultimate defense against herd mentality and the anxiety of checking one's portfolio every day.
It fundamentally defines the Grahamite investor. Investing must be approached like running a disciplined business, a systematic effort to maximize the likelihood of a reasonable return and minimize loss. Following the crowd or letting popular sentiment dictate your price is the definition of unsystematic and undisciplined behavior.
It's speculation.
It's speculation. The independent thinker recognizes that market prices are merely opinions. Intrinsic value, when calculated correctly, is a verifiable fact.
And the beauty of that independence is that it directly enhances the margin of safety. If you are buying what the crowd despises, the deeply undervalued asset, you're often buying it at a price that maximizes your buffer against loss.
Absolutely. The margin of safety is a financial concept, but independent thought is the psychological mechanism that allows you to exploit it. If everyone agreed on the true intrinsic value, the discount wouldn't exist. Graham's success relied on having the courage to buy what others were too fearful or too ignorant to buy.
It is essential to ground Graham's theories in reality. He wasn't just an academic, he managed money successfully for decades at Graham-Newman Corp. His methods worked, and worked remarkably well, during an incredibly turbulent period in global financial history.
His track record provides irrefutable proof of concept. Graham-Newman Corp yielded an impressive approximate 20% annualized return over the crucial 20-year period from 1936 to 1956.
20% annually for 2 decades.
Yes. And this wasn't merely matching the market. This significantly outperformed the overall market performance, which averaged about 12.2% annually during that same time. This sustained, substantial outperformance demonstrates the profound efficacy of deep value investing.
That kind of consistent outperformance over 2 decades, covering everything from the tail end of the Depression to the post-war boom, confirms the durability of his analytical approach. But the case that truly immortalized his ability to spot value was the investment in GEICO.
The GEICO case study is a textbook example of finding the margin of safety in an obscure, unconventional place. Graham-Newman purchased a 50% interest in the government employees insurance company, GEICO, in 1948 for a paltry $712,500.
A steal in hindsight.
An absolute steal. This was a classic Graham purchase, an undervalued asset in the insurance space with predictable cash flows and sound underwriting practices, trading far, far below its potential.
Why did they buy a stake that large? Why 50%?
They bought it because the market was completely ignoring it. It wasn't flashy. It didn't fit the popular narratives of the day. It was a classic net-net type of investment. Huge tangible value, low expectations. Graham's skill was identifying businesses where the assets and earnings power were demonstrably worth far more than the price tag.
However, the firm couldn't hold on to this legendary investment permanently, which is a fascinating regulatory twist in the story.
That's right. Due to regulatory limitations imposed by an SEC order related to rules governing investment company structures, Graham Newman was compelled to distribute the GEICO stock directly to its fund investors upon the fund's eventual dissolution.
So it left the fund's balance sheet.
Exactly. It became a direct individual holding for the investors who owned shares in Graham Newman.
And the long-term impact of that forced distribution for the individual investor who held onto the asset is absolutely staggering.
It demonstrates the power of time and intrinsic value compounding. An investor who owned just 100 shares of the Graham Newman Fund in 1948, then valued at $11,413, and crucially held on to that distributed GEICO stock, would have seen that stake grow to a monumental $1.66 million by 1972.
From 11,000 to over 1.5 million.
That is phenomenal wealth creation stemming from one single, deeply undervalued purchase.
And the story gets even better, because the GEICO value didn't peak there. That value was later confirmed and capitalized upon by the next generation of value investors.
Exactly. GEICO was later fully acquired by Berkshire Hathaway in 1996, highlighting that the long-term value originally identified by Graham in 1948 was later confirmed and capitalized upon by his most famous student, Warren Buffett, securing Buffett's permanent connection to that initial brilliant acquisition.
So the GEICO story is a complete historical loop.
It is. It links the father of value investing directly to its modern master.
Graham's success wasn't just about what he bought, it was also about what he railed against. He was a relentless critic of the prevailing corporate culture and market practices of his time, and his observations remain strikingly relevant today.
He fundamentally believed that corporate management had an obligation to the owners, the shareholders, and he felt that obligation was often ignored or actively undermined through poor reporting standards.
What were his primary criticisms regarding corporate reporting?
He was highly critical of corporations for using what he termed obfuscated and irregular financial reporting. He argued that this lack of clarity was intentional, making it extremely difficult for the average or even the skilled analyst to accurately discern the true financial state of the business.
So he demanded clarity.
Absolute clarity and transparency, precisely because security analysis, the calculation of intrinsic value, is impossible without verifiable, understandable data. He saw complexity as a refuge for the unscrupulous.
If the numbers are murky, the margin of safety calculation becomes impossible, and the operation immediately flips from investment to speculation.
That is the core linkage. He also had a very strong position on how companies should use their profits, especially when they couldn't find productive internal uses for that capital.
He was a famous advocate for dividends. Why such a staunch defense of distributing profits?
He criticized businesses for hoarding all of their profits as retained earnings if management could not demonstrate an ability to reinvest that capital at a demonstrably higher rate of return than the shareholders could achieve elsewhere.
So if you can't beat the market, give the money back.
Pretty much. Graham believed that if management was merely stockpiling cash or using retained earnings inefficiently, that capital should be distributed back to the owners, the shareholders, so they could decide where to invest it more productively.
This position fundamentally challenges the structure of many modern corporations, especially in the technology sector, which often prioritize reinvesting everything for growth, viewing dividends as a sign of managerial lack of ambition.
Absolutely. And this leads to his final major criticism against the philosophy of growth at any price. He harshly criticized analysts and investors who advised that certain stocks were a good buy at any price based solely on the prospect of unlimited earnings growth, without conducting a thorough, fact-based financial analysis of the underlying business's actual condition.
So buying a story.
For Graham, buying a high-growth stock without anchoring to demonstrable value was the very definition of reckless speculation.
No philosophy, no matter how foundational, remains static. Graham taught generations of investors, but his most famous student, Warren Buffett, along with his partner, Charlie Munger, effectively updated the doctrine. We have to discuss this critical evolution.
This is a crucial nuance. Both Buffett and Munger have stated repeatedly that while Graham's methods are necessary, you must understand how to value a company and protect your principal. They are not entirely sufficient for achieving stellar success in contemporary investing.
What was the inherent limitation of Graham's deep value approach in a rapidly changing economy? What was the missing piece?
The critique centers on Graham placing too little emphasis on the potential for future growth and the quality of the business. Graham favored deep discounts on existing measurable value. He preferred $1 in tangible assets today over the promise of $10 in earnings 10 years from now.
So he was so weighted towards safety and current discount that he sometimes overlooked truly exceptional companies, businesses with huge sustainable competitive advantages that appeared expensive on a liquidation basis but had massive durable growth potential.
Exactly. Buffett famously said it was Charlie Munger who pushed him beyond buying merely cigar butts, businesses that had one final puff of value left, to buying wonderful businesses at fair prices. The focus shifted from quantitative cheapness to qualitative excellence.
That transition is summarized perfectly by Buffett's realization. Graham taught him how to avoid losing money, but Munger taught him how to make a lot of money by recognizing superior business quality.
The sources capture this sentiment powerfully. Buffett, in an interview with Fortune in 1988, stated, "Boy, if I had listened only to Ben and not also to Charlie Munger, would I ever be a lot poorer?"
Wow.
And this quote doesn't disrespect Graham at all. It demonstrates the natural, powerful evolution of financial thought. Graham built the foundation, the discipline, the margin of safety, the analytical rigor. Buffett and Munger then built the superstructure, integrating the quality of the business moat, brand power, and future competitive prospects into the intrinsic value calculation.
Graham's forward-thinking mind extended well beyond the academic world of analysis. He was surprisingly active in areas that feel very modern, specifically in shareholder activism, decades before it became a fashionable, high-profile strategy.
He was an early and often fierce practitioner, driven by his conviction that management must be honest and efficient with the owner's capital. The sources cite the Northern Pipeline affair as a key example, involving one of the biggest industrial fortunes in America, the empire of John D. Rockefeller.
What was the core conflict with Northern Pipeline Co.?
Graham's deep research revealed that Northern Pipeline Co. was holding vast assets, primarily cash and government bonds, that he believed were grossly underutilized. The management was hoarding this capital, precisely the behavior Graham criticized, rather than employing it productively or distributing it to shareholders.
So, what action did he take?
True to his belief that a shareholder is an owner, Graham bought a significant stake enough shares to force a proxy vote. He compelled the company to distribute those excess, hoarded assets to the shareholders.
A radical move for the time.
A radical move. He used meticulous security analysis not just to find chief stocks, but to enforce good corporate governance and unlock value actively. He proved that value investing can sometimes require intervention.
He didn't just passively wait for the weighing machine to operate, he actively forced the weighing machine to turn on.
That is exactly the distinction. And demonstrating his incredible farsightedness in minimizing investor effort, Graham was also an early staunch advocate for the creation of index funds.
Decades before they were introduced.
Decades before they became mainstream.
That seems like a massive contradiction. Why would the father of active fundamental analysis advocate for passive investing?
It connects back perfectly to the defensive investor philosophy. Graham was intensely practical. He recognized that for the vast majority of people attempting active, enterprising investment leads to inevitable failure because they lack the time, skill, or emotional discipline.
So this was his solution for them.
He saw index funds as the practical, low-cost solution for the masses to adhere to the core principles of minimizing effort and maximizing long-term returns without succumbing to speculative behavior or the emotional whims of Mr. Market. It was the best way for the average person to achieve an adequate return safely.
Now, this is the deepest dive territory. The sources detail the one contribution that Benjamin Graham himself, the man who wrote the financial Bible, regarded as his most important professional work. And it wasn't about individual stock picking or security analysis at all.
That's right. His most important work, in his own view, was in complex macroeconomic theory, specifically currency stabilization and reform. This work was detailed in his lesser-known publication, World Commodities and World Currency.
He proposed a fundamental structural change to global finance. What was the core of this alternative currency theory?
Graham proposed an alternative to the prevailing gold standard. His idea was to replace the gold standard with a commodity reserve currency. The logic was powerful. The value of the currency would be stabilized by backing it with a globally significant basket of storable raw commodities, like oil, copper, sugar, and wheat.
Why commodities instead of gold?
Well, gold is finite, and its supply is erratic relative to global production needs. A commodity reserve currency, anchored to a basket of real-world goods, would provide inherent stability and also help counter deflationary spirals.
How would that work?
If the currency gained too much purchasing power, the reserve would sell commodities. If the currency weakened, the reserve would buy them, thus stabilizing prices. Graham saw it as a systemic mechanism to promote balanced global trade and minimize financial crises.
And the relevance of this incredibly complex, far-sighted work continued long after his active career ended.
Absolutely. This currency theory gained renewed attention and serious consideration decades later, particularly following the systemic turmoil of the 2008 financial crisis, as central bankers and economists desperately sought structural improvements to global monetary stability. It just showcases that Graham's genius was applied to the largest structural problems in finance, not just the microanalysis of a single stock.
We've seen that Graham's principles are dynamic and have evolved, but his intellectual influence remains the essential starting point for any serious investor. The list of successful investors who trace their strategies back to him, it reads like a financial hall of fame.
His influence is foundational. Beyond Buffett and Munger, we must include his direct disciples who achieved massive success based purely on deep value methods, like Irving Kahn and Walter Schloss. Schloss famously ran a fund based almost entirely on Graham's net-net strategy for decades with great success.
And the contemporary stars of investing.
Well, the modern practitioners of disciplined, value-oriented investing include figures like Seth Klarman, Howard Marks, Bill Ackman, and Nancy Zimmerman. All of them credit Graham's texts as essential training. Sir John Templeton, known for global value investing, also incorporated Graham's analytical rigor into his international strategy.
It's the unifying foundation of the entire deep value school, across diverse sectors and geographies.
Indeed. And the ultimate proof of his enduring influence is institutional. The sources confirm that security analysis or the intelligent investor are still mandatory, required reading for new hires at many top investment firms worldwide.
Still today.
Still today. They are not merely historical artifacts, they are living, functioning textbooks. If you want to understand the universal, timeless language of value, risk, and analysis, you must begin with Benjamin Graham.
So what does this all mean for you? We have traced Benjamin Graham's remarkable journey from a young immigrant named Grossbaum, scarred by the trauma of the 1907 panic, to the undisputed dean of Wall Street.
A long journey.
A long journey. And his enduring gift to us is not a magic formula, not a list of stocks, but a set of analytical tools, Mr. Market and the margin of safety, that compel us to manage our own emotions and stay rigorously focused on verifiable, intrinsic value.
Graham formalized the entire analytical process and insisted that financial decisions be based on facts, on reasoned probability, and on logic, never fleeting sentiment. His philosophy ensures that you gain knowledge quickly but thoroughly, allowing for those crucial aha moments about separating what you pay, the temporary price, from what you get, the durable value.
And his personal philosophy, driven by generosity and curiosity, is just as compelling as his investment acumen. Graham's most powerful legacy might be his personal credo, which Warren Buffett shared. Graham used to say that he wished every day to do three things: something foolish, something creative, and something generous.
And Buffett noted, based on his close, decades-long relationship with his mentor, that Graham excelled most at the last at generosity. That speaks volumes about the character of the man behind the rigorous analysis, whose principles were intended to enrich others, not just himself. So here is the final provocative thought for you to consider, building on everything we've discussed. Benjamin Graham retired from active investing in 1956, long before the rise of the digital economy.
A different world.
A completely different world. Given his historical critique of management hoarding profits, his push for corporate transparency, and his aversion to speculative growth at any price concepts in the 1950s. If Graham were analyzing today's colossal, rapidly expanding tech giants, many of which prioritize intangible assets, network effects, and reinvesting every penny over dividends and tangible asset statements, how would he rigorously apply the margin of safety concept? And would he ultimately classify these contemporary market leaders as true Grahamite investments or merely high-stakes speculations?
That is a fundamental challenge to today's conventional wisdom, and it proves that Graham's principles are not dusty history, but timeless, living tools that demand continuous application and evolution in every new market era. Thank you for joining us for this deep dive. We hope you feel well informed.